So very good afternoon. The risk and return characteristics of mutual fund. The first funds already have been discussed in the previous class. I have said about the mutual fund vary, how potentiality of mutual fund, different types of security and investment plan, investment objective of this mutual fund, and various equity funds which are available in the market. This have been briefly explained to you, and how the risk return profile and the character with the example has been explained in the previous class. So coming to the second point, we have a bond fund which is also called a fixed income fund, investment in a fixed income security which is suitable for income generation and the capital preservation. So when it's come for bond fund, we talks about the funds which in form of debt fund also. The bond fund also called debt fund, which are returned in form of a fixed income. Bond fund can be also called a debenture, like investment in the debt and debt securities, where volatility of the market increases also, fixed income remains same, the market decreases also, income remains. So investment in the fixed income security which are very much reasonable. Many people, to avoid the risk, they just invest this kind of a debt funds, and they just seek the opportunity exactly that how investment are made into transparent and get fixed income which generate the capital preservation. And you can see here risk moderate, which is low here. Risk is very low compared to equity fund. Return are moderated with the regular income. The characteristics like investment in the government and the corporate bond providing stable return. And we'll see the different character, how these investments are made in the different types of segment. And risk depends on the bond types, and classification of this risk depend in form of government bond, safer higher yielding corporate bonds, right? See, when it's come for the character, this bond especially, or this fund especially, will yield fixed rate of income. I said the bond, debenture, government security, where public invests in the open market about thinking that my investments are safe. Why safe? Because they are protected, they are safeguarded with a fixed rate of income. It is not like about like a equity fund where you invested. If market is high, you get a more profit. If the market is low, you get low profit, or low form of profit, and high is the risk. But here is not like that. It's the reverse of that. A market grows but income remains same, or market will fall, income remains same. It has a moderate to low, always risk is moderate to low. And return also is at the regular income. People expect a regular income which is called fixed income. The character in form of investing in the corporate bond and the government bonds, government securities, which will yield a good high, good return. Or some of the corporate bond also, they are very much safer than any other bond. Some of the sensitive to interest rate changes, like raising rates reduce the bond prices sometime. So people just invest in this, such kind of a bond where expectation is not that high, but one fixed or average expectation of return can be met here. And this itself will classify how risk return profile can be considered, and it are attached to market, and what based on the market it has evaluated and fund category. So then example like government bond funds are low risk, low to moderate return, expectation also very less, and the risk return profile also will be very less. And corporate bond funds moderate risk, high return than government bonds. So this is the comparison between government bonds and a corporate fund. And this always classify how this is high and low funds with the low to moderate return, moderate risk with the higher return than the government bond. Then high yield bond fund like potential higher return. See, in the market itself, even after you are safer side, your income is fixed, but somewhere it is calculated, somewhere it is classified how risk return profile has been important, and based on the investor pattern how it can be fixed. So fixed fund, fixed income funds are very much required in form of many clarity on the fund investment return expectation. So these are the main risk return character and example I have been shown on the bond fund. The next slide talks about money market fund. A money market fund, which talks about in form of investing in the open money market in form of commercial paper, treasury bill from the government, commercial paper from the banks. So there are people who invest in the commercial paper through in form of bank investment and the treasury bills through government treasury bills, and they expect in form of hybrid funds which combine the different types of debt equity classification, where return and the risk also as in moderated, not low not high, it is always moderate. So it might be, I can tell it might be fixed also money market, but it depends with the money market funds how it has a growth. So here risk is very low, it is equivalent to almost equivalent to debt investment, and the return also low here, but you are very safe compared to any of the funds here. So invest in short term high quality debt instruments. It prioritizes the capital preservation liquidity, and it classify typically by offering low but stable return, often below inflation, and suitable for risk averse invest or short term goal. So this is how it is classified. So many of the time the investment pattern, it goes on the different calculation how it is suitable. So I said about sectoral funds in form of focus in specific sector or industry which is suitable for investor for high risk appetite. I can tell you sectoral funds, it's similar kind of money market where the sectoral funds always talks about a investment made in form of industries or specific sector, and meanwhile it is very suitable for the investor with the high risk appetite. Then you have index fund to where track a specific market index and offering broad diversification low cost. So index fund also talks about market index offering broad diversification. So here you have to evaluate all this risk analyzation. Now if I talk about money market funds here, there is a return, there is a risk, there is a consistency, and there is an expense ratio. So analyzing the fund performance, which are evaluated based on the transaction, they are based on the different classifications. So here I can compare the fund with the return in form of benchmark, right? I can compare, say, any return. If I want to analyze the fund performance, I compare the fund's return and I set one benchmark with the peer funds. So set of a group of funds where which has a high growth, high return, and which has a less growth in case of classification of different types of funds. So then risk attachment. So analyzing of fund performance based on the risk assessment also goes with the different form, like you have a profile of using the metrics like standard deviation beta form. So risk assessment also done based on the fund's risk profile. So metrics like standard deviation, the beta performance. Then the consistency to evaluate the fund performance, consistency over different market cycle, and it will evaluate the fund performance based on the different class of cycles, market ratios, market analysis. Then they go for expense ratio too. So one money market fund, when I said treasury bill and commercial paper, they identify the expense ratio where this consider the fund expense ratio as a lower cost than the lead the higher return. So that's why we call money market funds are very low and the return is low here. The lower it has a fund expense ratio itself in the lower cost. When cost itself is low, so you can't expect more return, so your risk and return also will be low. So analyzing performance based on the different evaluation method, they go for return, risk, consistency, and the expense ratio. These are the categories, and this characteristics it has been explained like investment in short term, medium, or high quality debt instruments, prioritizing your capital and liquidity, and offer low but stable return and often below inflation, suitable for risk averse investor for short term goals. So this is how it go for classification. Then the next slide is about the balanced funds, what we call hybrid. I was talking about the hybrid fund in the previous class, where it is a combination of equity and debt instruments, and it will yield one return and stable return. At the same time, you can expect that profit also. You can expect that average expenses too. Why? Because they are the combination. One side expenses. When I talk about expenses, you are going to pay a fixed rate of return in form of debt as an interest. So that become a moderate risk, return also moderate, and hybrid funds combining offering balanced approach, debt and equity instruments. So that become a hybrid fund. So when you combine, so it is also called a balanced fund. You balance your debt with the equity. So 60% is the equity, 40% debt, or 50% is the equity, 50% debt, 70% is equity, 30% debt. But you balance somewhat your average income with the expected future expenses. So one side you talk about the interest which is paid, interest which is invested in form of debt, where you get a return because you invest in form of debt instruments. Another side, even if you lose in the market, it is offset with the debt equity instrument. So hybrid always talks about the combination of both. So the character talks about diversifying across stocks for growth and the bond for stability, and the risk return depend on the allocation between the equity and fixed income. Then suitable moderate risk investor looking for balanced growth and income. See, many of the time what happens, people invest in such kind of a funds where I need a income but risk should be moderated. My risk should not cross as a expenses where I can offset my expenses based on my whatever income has been earned. So here the character talks about you diversify across the stock in form of growth and bond in form of stability. See, stock always in form of growth and the bonds always under stability. Risk return depend on the allocation between the debt and equity, which is fixed income, right? And the suitable market, which is moderate risk investor, also has to be focused on the balanced growth and income classification. So here they classify which are the character, which are the fund which is needed, which is required in form of favorable asset in favor of unfavorable investment. So here example also given: aggressive balance fund, high equity allocation, more risk, and conservative balance fund, high bond allocation, less risk. So this is further classified when it's come for SS fund manager expertise. How fund is balanced and what investment pattern is required in form of what. All these are taken into consideration, and that's being identified as an aggressively or conservative in form of allocation of funds in form of bond, allocation of fund in form of other classifications. So here uh, I can tell you about the SS fund manager, where they evaluate the fund based on the experience, based on their track record, based on the investment philosophy. So fund manager will assess their experience in managing similar fund, track record. They evaluate the past performance and consistency. They go for philosophy, that understanding their investment approach and the strategy. And I said in the first class that understanding investment plan is important rather than directly investing. So you structureize your financial plan first, then just go for drafting of your investment plan. So based on the asset management fund expertise, you go for experience based recording about their track, which in form of different classification, and in form of based on the consistency, in form of philosophy to understand the investment approach and different types of strategies. So this is classified based on the different need, different objectives. So next we can see the last slide about fifth one, as an index fund. There are various funds where you can categorize understanding your investment plan. Index funds are already I said about. They are the track of specific market index, offering broad diversification, low cost. A track of specific market index which based on the diversification and the low cost. And here risk are low to moderate It is not like the previous. There were the mod in case of moderate and low. Here it was the risk vary from the low to moderate, and return matches with the market performance. That's why I said index fund is always based on the market index, and it might be has a broad diversification, but it has a low cost. So accountability, matching with the market performance, and varying with the low moderate risk profile is required. The character talks about track of a specific index asset that you invest SIP, systematic investment plan, starting with the 500 rupees, or topmost 500 companies, right? So Unilever, so no active management, track of specific index is recorded, low cost due to passive management, risk mirror that index volatility diverse across the index components, suitable for long-term investors seeking market return. So index funds are matching with the return, but at the same time they are also classified a specific market index offering broad diversification, low cost. So this is much comfortable, much better compared to any other risk return profile than talking point of SS fund manager. I said experience, track record, and some of the consider of other factors like fund size. When it's come to index funds, fund size, liquidity, tax efficiency, customer service, where the fund size larger fund may be stable but may also be less uh, eligible when sometime liquidity, evaluate the fund's liquidity, especially debt fund. Then tax efficiency, it considers the tax implication that how investing in particular fund, and the customer service, says the fund house customer service and they support the customer service. Then they go for different diversified portfolios like asset allocation, diversification, or regular portfolio rebalancing. So when I see the create of a diversified portfolio, many of the time investment across different asset class, sector funds or funds to minimize the risk, they go for diversified in form of asset allocation. Investment based on your risk tolerance and investment object. See, every investor allocate asset in such a way that investment based on the risk tolerance, how much risk they can tolerate, and what are the investment objective or the purpose. And this is very much key. They are very much considered when it's come for allocation. So allocate your investment based on your risk tolerance and investment objective. And it is in simple form that how sectoral funds have been used here, diversified funds, portfolio of this diversification to minimize the risk fund, and they just go for the diversification in form of a mix of equity, debt and hybrid fund to reduce the risk. See, normally uh, when I just go for diversification, investment in a mixed equity, debt and hybrid fund to reduce risk, they further classify different form of equity funds, different form of debt fund, different form of hybrid funds, where risk reduction might be moderate. So one, I said about asset allocation on the various funds, where you allocate the asset based on your risk tolerance and investment decision and the objective. At the same time, diversification, you require a mixed response, like how much is the debt, how much is the equity, how much is the hybrid fund. And there is a regular portfolio rebalancing, like periodically review and adjust your portfolio to maintain target asset allocation. The many of the investors, they just go for reviewing how to review and why this review is done. Many of the classes, they go for reviewing that whether my investments are in what basis have been invested, in form of what risk return profile, and how long this risk return profile. So here character, uh, track a specific index, I said, lower the cost due to passive, I said. Then risk mirror, volatility, I said. Then long-term investor seeking market return. So you might be seeing different types of a uh, classification in form of what. I have said also about sectoral wise or hybrid wise or equity or debt combination of both. So all you need to go through for one of the understanding patterns. So different characteristics of understanding different mutual funds. So remaining we'll see in next class. Thank you all.